Today, we're putting a real Canadian financial heavyweight, Sunlife, right under the microscope. We're going to try and figure out if this is a golden opportunity for your portfolio or if its sunny outlook is, well, already priced in. Let's find out.
So here it is, the big question we're trying to answer today. Is Sunlife a reliable engine for long-term growth, a true dividend compounder, or is it a giant that's already kind of reached its peak valuation, This is what our entire analysis is really going to hinge on.
So what's Sunlife's game exactly? Well, it's basically a two-pronged attack. On one hand, they provide life and health insurance. On the other, they manage enormous sums of money. This means they're bringing in profits from insurance premiums, they're collecting fees on retirement and investment funds, and they're generating returns from their own pretty significant investments. It's a business model that's really designed for stability and long-term growth.
All right, so we know what they do, but now for the multi-billion-dollar question, what is the business actually worth? Let's get in there, crunch the numbers, and try to find its intrinsic value, setting aside all the daily noise of the stock market for just a moment.
So how in the world do you arrive at just one number for a company this big and complex? Well, this analysis uses a pretty smart two-pronged approach. First up, you've got the discounted cash flow, or DCF. Just think of this as trying to estimate all the future cash the company will ever generate and then figuring out what that's worth in today's dollars. That gets us to about $101. Then you've got the modified earnings value, which looks at the company's average historical earnings to get a value of $95. By blending these two different perspectives, we arrive at our most balanced estimate.
And that blend, it gives us our magic number, $98. This right here, this is the anchor point for pretty much everything that follows. So definitely keep this number in your head as we move forward.
Okay, so a company's intrinsic value is one thing, but what we really care about, right, is how it compares to the price we can actually buy it for. At the time of this analysis, the stock was trading at $89. That means there's a 9% gap, which investors love to call a margin of safety. It's kind of like a small buffer, just in case you're wrong. But, as the analysis points out, a 9% buffer, it isn't exactly a fortress,
Okay, so we've got our price target. But here's the thing. A cheap price for a broken company is no bargain at all. So now, let's pop the hood and really inspect the engine of this business to see if it's built to last.
Before we start listing Sunlife's advantages, let's just quickly define a super important term, the competitive moat. Seriously, just think of it like a castle's defense system. It's what protects a company from being overrun by competitors, and it's what allows it to earn solid profits for years and years and years.
And wow, this slide really brings Sunlife's moat to life. It's not just one thing, it is a seriously powerful combination of factors. You've got immense brand trust. We're talking about people's life savings here. They have these vast distribution networks. Their massive scale creates all kinds of efficiencies. The regulatory hurdles to even get into this industry are sky high. And maybe most importantly, their customers are incredibly sticky. Once you're in, you tend to stay for a very, very long time.
A great business can be absolutely ruined by poor management. It's like having a bad captain on a great ship. So, the next logical question has to be, does the leadership team at Sunlife actually work for the owners of the company, the shareholders?
So how do we grade the management? Well, this one number tells a really powerful story. In the last 5 years, Sunlife has bought back and retired over 4% of its own shares. Think of it like this. If you own a slice of a pizza, and the company removes some of the other slices from the box, your slice just got bigger. It's a classic shareholder-friendly move that shows management is focused on increasing value for its existing owners.
Okay, so we've seen the strengths, and they're pretty impressive. But no investment is without its risks. To be smart about this, we really need to look at the whole picture, the good, the bad, and what the future might look like. Now, this is not your standard run-of-the-mill SWOT analysis. See, here, each factor is actually weighted for how important it is. You can see powerful strengths like their brand and their dividend stability get really high scores, but potential threats like regulatory risk, they act as a counterweight. When you tally it all up, the analysis gives Sunlife a pretty respectable score of 3.4 out of 5. So solid, but definitely not without its vulnerabilities.
With those strengths and weaknesses in mind, let's play out a few possible futures. It all really hinges on one key metric, return on equity, or ROE. That's basically just how efficiently the company makes profits with its assets. So in a pessimistic or bear scenario, if ROE drops, the intrinsic value could fall down to $80. Our base case, as we've already talked about, is $98. But in an optimistic or bull scenario, maybe driven by strong growth in Asia and a higher ROE, the value could climb all the way to $115. Okay, we've done the deep dive. We've looked under the hood. Now for the most important part. how do we turn all this analysis into a concrete investment plan? Let's talk about specific price points. This is where the analysis gets really useful. It gives you a roadmap based on your personal investment goals. As you can see, if you're targeting, say, a 7% annual return over the long haul, your max buy price is $92. But if you're a little more ambitious and you want a higher return of 9%, well, you're going to need a bigger margin of safety. So your buy price has to be lower at $82.
Now let's slice this data another way. Let's say we lock in our target return at a solid 9%. This slide shows how your investment timeline actually affects your entry price. And notice this, the longer your time horizon, the slightly higher price you can afford to pay today. That's the magic of compounding, working in your favor over many years.
We have looked at the numbers, the business, the risks, and the potential rewards. So, let's boil it all down. What's the final verdict? What are the key things to take away from all this?
And here it is, the bottom line straight from the analysis. It's not a simple thumbs up or thumbs down, but a much more nuanced strategy. The recommendation is to hold at current levels. If the stock shows some weakness and happens to drop below $82, that could be a buying opportunity. On the flip side, if it rallies up past $105, it might be time to trim the position a little bit.
So, let's just quickly recap the most important points. Sunlife is a stable, high-quality business. It's consistently profitable, and that dividend is a really attractive part of the whole investment case. At its recent price, it's trading at a modest discount to its estimated intrinsic value. And the key action point to remember, for those of you seeking a 9% return, the price to watch for is below $82.
And there you have it, our deep dive into Sunlife Financial. So what's the verdict? Well, it's a high-quality, stable company, but at its current price, it seems to be fairly valued rather than a deep bargain. Now it's your turn. What company should we put under the microscope next? Let us know down in the comments. Thanks so